Welcome back to Slot Leader. I'm your host, Umed Saidov. This is part 2 of episode 7. We are back with Colin Edwards, and we're going to continue to discuss cryptocurrency trading. I see. Now, why an hourly resolution? Can you tell us about that?
I tend to think on hours. I think as you get too granular, and sometimes granular is quite useful if you look at what kind of flows through. But I tend to look at volume weighted prices as well. So I might look at a volume weighted average price for movements, so that tends to give a better signal for mission. And I tend to think about how likely is it going to be in any particular hour. There's certain hours where you have a lot of buyers and sellers. So that's just a time range that I tend to think at.
Okay. Now,
So different
why
trades
not 4
could,
hours? Why not 4 hours?
you could,
Okay.
I think that there's a lot of ways to do it, but I find that it's easy for me to think in hours, and
Okay.
that's one that I've found effective. Other people will do trading on different time scales, so I tend to be in, not high frequency, but in terms of things that happen within an hour, once or twice a week. So I'm looking at big hours where they're going to move once or twice a week, and that's it's frequent enough that it keeps coming, but it's not so frequent that I can't kind of mentally keep my mind around everything happening.
Okay, so from what I'm gathering, if you are a market maker, VAR is going to be your sort of guide in terms of where you want to exit. Now, the question
or trade,
trade, okay,
yeah,
exit or
enter
enter.
or exit.
Yeah,
I think it's a useful enter or exit measure of just what kind of moves are likely. You don't want to be too far outside there because
yeah,
you're never going to get hit. You don't want to be too close in, or if you are, you're working at a different market. You're just making that spread all the time. You're not taking a liquidity view on it. You're kind of competing in that high frequency market making. If you're competing in tighter, you've got to be trading on a much more frequent basis.
I see. So, okay.
And operationally, that's harder. It's Python. I'm a Python programmer, so
Yeah.
I find it. Python works fine on hourly basis. If you're working on seconds or milliseconds or faster responses, you might need a different technology. I don't have a great connection. I don't have a high, a co-located server or anything like that. So you kind of want to pick a time scale that works with your operational concerns.
Okay. Now, the question here looking at this VAR chart is that how do you identify differences in sort of states? For instance, one of the things in statistical analysis is trying to identify the the points where your previous statistical analysis may not hold, and you might not get the immediate information about that change in the state until whatever your average period is to you get to that point, if you know what I mean. So how do you sort of account for that? So let's say that the VAR here is the bandwidth you're talking about is 95 to 95% whatnot, and let's say that the nature of price movements changed from one point beyond. Is there a way to identify that?
Yeah, I mean, one of the things that this is again one of the reasons I use an exponentially weighted moving average is just to take that through so quickly. And particularly when you're looking at it at a high decay, it's sort of on the last 3 weeks is a lot of the focus. What's happened recently, and when you're looking at an hourly, that might even be what's happened in the last 3 or 4 days, and so you're placing a very high amount of focus on just the most recent history. And I think that works quite well with certain momentum as you see periods of lots of trading and periods with much less. And there are day of the week effects. Certain days people tend to profit take. For example, my miner, he trades on Thursdays. I don't know why. So I'm always just kind of waiting around. Maybe this Thursday I'm gonna get it, and so there's a certain frequency, and you observe those things. You say there's certain frequencies that people trade on certain days of the week, and news cycles have an effect on that. And there's a number of different things. Different times of month have different effects. But I think having a fairly rapid decay on those numbers is useful. And so I tend to adjust where I am based on just fairly recent history. So it's really the last, say about 4 or 5 days tends to have the largest weight.
Okay. Well, that's a great way of actually, protecting yourself against these kind of eventualities. Do you want to walk us through, because you said that there are more than one strategies that could be employed. You walked us through the market making. Is there any other types of strategies that you would like to discuss in depth?
Sure. I'll actually go through two if I've got time. One of these is a kind of a mean reversion trade. And this is one where you could look at two different coins. In this case, I'm trading a coin versus it happens to be a basket of other coins. And this is the kind of trade that in Europe, you can trade using what's called a contract for differences on a site like eToro. The UK government recently came in and said from January, this type of trading will not be allowed for UK citizens. So that's a limit, and certainly this is something that generally is not available to US citizens at all. And so that would be much more limiting in terms of trading, but there's some ways to take advantage of it. Now, a contract for difference, you're just essentially taking the return. It's a very much what we called a total return swap, where you are paying the returns of one asset and you're receiving the returns of a different asset. And these sites will often allow you to put these trades on, as well as having certain things that are very useful for algorithmic trading, like stop losses. One of the challenges of a contract for difference is you might be open to unlimited losses if you were short Uniswap when it went to the moon. You might lose a lot of money. And this is, I think, one of the reasons why the regulation has come in. If people start losing their houses for doing this type of trading, the governments will strongly crack down. And I think, this is, as people look at on-chain exchanges, this is something that we are thinking about a lot, of how do you make it so that individual investors or traders, have at least some confidence in what they're doing. We have a lot of legal people that look anything we do either. But just in personal trading, this is an example of where you have coins. This is EOS. It's one of the coins I have in a basket of coins that I conceptually think about as coins that seem like they are taking good ideas from other coins, and they are using the best ideas and growing with them. And ADA, of course, is in this basket as well. Ethereum and a number of other very publicly well-known coins I tend to think about as sort of the 3.0 coins that are looking at doing something better. And the reason that I use these as a basket is I have a pretty strong feeling that if one of them comes up with a good idea, the others are going to start getting that onto their development list pretty quick. And so I have a certain view of largely they're going to mean revert over time. They might occasionally go to new levels, but there is a sense of mean reversion.
Okay.
In this particular case, the way that you'd execute this trade is you'd have some rules. For example, when the orange line is above the blue line, I'm expecting those to converge back at some point in the future. And so I might have a rule about, when this level is 10% above this other level, get into the trade. And then
you buy the blue. Is that what it is?
I would, exactly. So I would sell the orange and buy the blue, usually something like a CFD.
Okay.
And that's going to, you're going to have to put some money down for that. And you're going to lose some money up front. So in a CFD like this, you might pay, say, 2.5% of the value of the trade up front. So that puts a limit on one of the reasons that a lot of people lose money on CFDs is it's not a 50-50. You've got to be making, and these are cases where about 70% of the time, if you can get your trade ideas to work in the 70% range, you can, on average, make money on them. And that is a kind of a discipline that I think is quite hard, because you just don't want to be, you want to have a signal that is wide enough to trade on, but it doesn't last so long that you're in the trade for months. And so this is kind of an interesting idea of, before you get in, if it's a certain amount, let's say it's 10% above, I expect those to mean revert. So there's 10% profit. So I've got a profit taking rule. When they get close to crossing each other, I'm gonna get out of the trade. So if one is above the other, I'm gonna buy one and sell the other. I'm gonna get out when they revert. If it goes the other way, I've always got a stop loss on there. And that's going to be one where you just don't want to trade these things with unlimited liability. You just take your loss and take your lesson. And this is one where back testing is very, very useful, which is just looking at historical outcomes and saying, if I had this trade, and particularly, it's very important to keep in mind what your costs and your slippage are. So if you're paying an immediate 2.5% up front, you're not even going to start making money until you're recognizing. And here I've got a 10%. I really want to take 10%. Just so that I've got enough margin to make some money. And some of the time you're going to go the wrong way. Things will pull apart and you just are forced out. And I've also got a time limit on these things. I usually, will say I'm going to recognize this in 2 weeks if it hasn't come back. And this is one where you can actually look at the time scales. This is a particular case where, you can see these things crossing each other on a week and a half, 2 week basis. They're not out there for months, and that also gives you a sense of what you're getting in for. You've got a maximum upside, you've got a maximum downside, you've got a fixed duration, and you can go to sleep at night. You're not going to lose your house. I think that's a really critical when you're doing these, is to have that discipline about where you think you can get in or out of these things in this market. And again, this is trading two names that are highly correlated. So you're not taking a view on the market going up or down. You're just taking a view that historically, these two coins have had a certain relationship, and they're going to come back to that relationship. This coin is, if it falls behind too far, it's going to start adjusting its behavior. If it gets too far ahead, the other coins are going to start taking some of the good ideas.
So my question to you with this setup is that how do you weight that index? Is it was it market based, market weighted, or how do you
That's a good question. This particular one, it happens to be evenly weighted among the coins, simply because that's very easy to book. When you put that trade in, if you have too many tickers, it's kind of a pain. And so it's useful to just say, I'm going to slice a certain cash amount. Another way to do that is, often I will look at, use PCA to come out with a market index. Principal component analysis is one way of looking at how much things kind of explain each other, and this is sort of a market effect. And then you can look at the volatility of the asset and essentially use what's called the beta, or the sensitivity to the market move. So you can create a theoretical market portfolio and use some betas to that. There's also a number of other types of machine learning algorithms. I find that like a lasso regression is pretty good at identifying trades, again, that or ridge regression actually is probably even more effective of ways of just how do you, given an index that I've kind of created out of thin air using PCA, what holdings do I need to actually replicate the value of that index? And so that's just a straightforward machine learning. These are my returns. This is what I'm minimizing. Give me my weightings, and it just comes out with a portfolio of things like that.
Okay. So
And so that's
yeah.
one, I think that kind of mean reversion trading is certainly one that is kind of an interesting. You see a lot of this kind of algorithmic trading in hedge funds.
Mm-hmm.
This is going to be a very common type of hedge fund trading. So a lot of players are doing this. And that's another thing that forces sort of the convergence is once people start trading around things converging, they're buying one and selling the other. It actually, it, it encourages people, it encourages that mean, reversion as well.
Yeah. I mean, I when I looked at trading like this, my biggest sort of concern, and this is like 3 years ago. My biggest concern was that I couldn't actually do naked shorts, and that was the problem with this kind of types of trades. But as you say, if they have a product that's addresses that issue, that's perfect. Even though we can't do that anymore. So.
I think it's a huge opportunity actually for crypto and distributed exchanges to offer these kind of products, because I think that when you're risk managing, for example, if you own a large amount of stock in a company you work for, being risk averse, the first thing you probably want to do is somehow diversify your stock holdings. You don't necessarily want to hold stock in a company you work for. So something like a contract for difference is very good, because you can say, okay, I work for a major bank, I work for Goldman Sachs, and they gave me a huge stock bonus. I wish this was true. But in my hypothetical example, let's say we went public and I got, my annual salary in stock. And so I'm sitting on this stock from the company that, they went public in 99. I worked there.
Okay.
But so theoretically, that I want to hedge out. I don't want to hold this stuff. I want my stock holdings to be a hedge in case I lose my job or the economy. So I really want to get out of things. And so a contract for difference is quite useful to say, let's take this holding in this company I work for. I might have a very strong bullish feeling about the company. Maybe I think they're a great company, but I don't want to be exposed to that risk. And I think that contracts for differences are one way of being able to manage your own kind of financial risks as an individual, where you might hold a company. If my name was Charles Hoskinson, maybe I want to hedge out some of my ADA risk.
Who's taking the other side of the trade, though? I mean, that's the problem.
That's a good question. Often they're going to be, many of these companies are essentially market makers. They're going to be trying, they're going to charge a spread, and that spread will be people that are taking the other side of it. So it's like a bookie. They're looking for enough people to be on every side of it.
Yeah, and then you actually face the question of liquidity of that guy. If I'm Charles Hoskinson, let's say I want to hedge, a 500 million ADA, and somebody says, okay, I'm gonna do that trade for you. You have to be able to analyze and be sure that when the trade comes, that he will show up and do whatever he said he would do. In official markets, there are ways to guarantee that. There are insurances. I'm not sure if does that exist in crypto.
Well, this is a good question about a DeFi product that doesn't exist. But if it did exist on chain, you'd have to have some sort of fixed loss term. So you'd have to have some sort of collateral that you could put up. You would have to have, you wouldn't have this unlimited liability. That can only exist because the government will step in and, make you pay these people, and they have a sense of identity. So if you were going to do this on chain, and as far as I know, this isn't done on chain anywhere as a financial product.
But it's
the kind of thing that you could do using, say, Goguen and Marlowe, but I don't think it's been done yet. So, people that are interested in building such a thing, check out, the Marlowe playground. And that's certainly one of the things they would show you how to you could engage that team. Simon is a brilliant, communicator and also in terms of mathematicians. And so that's the kind of product you could build using a language like that. But you'd have to have some way of having a fixed collateral, so you couldn't have this unlimited liability. You'd have to say, I'm willing to, put a stop loss on there, and you could price that. It's very similar to an option price. In fact, it would fall right out of option pricing theory. Okay. You could set an appropriate limit on that.
Oh, perfect.
It's a product that doesn't exist right now.
Yeah, but that's a great opportunity, to be honest. I might look into that.
And I think it's one that serves a real legitimate need, which is people looking to hedge their own risk, whether you're the owner of a company, whether you're the owner of a, whether you're an employee of a company that is rewarded in stock.
Or
I
if
think
you're
it
an
makes
ADA
sense.
holder and ADA is at $10 and you think that it's great that you have that, but I would like to basically protect the downside and you would like to hold it, but you don't necessarily want to endure the pain of losing the value as you hold. So you could just protect the downside at the top.
So as far as I know, Charles is not employing CFDs. In fact, I would say that there's probably our lawyers would probably be totally uncomfortable with this, given that he lives in the United States. I can guarantee that that's a non-starter for him.
Yeah. I mean, look, the way I look at cryptocurrencies in general and why I got into this space is that it's an open option with extreme volatility, and if the underlying technology is solid enough, then you will make a lot of money just by holding for a long term.
I think the ability to support these kind of contracts is one thing that really gives a lot of value, because there's a lot of open questions on how to make these contracts safe. You can't have people losing their homes. They have to understand the risks, and but at the same time, I think there's a huge opportunity for contracts, if they existed, for people to kind of manage their own financial lives better. And I think as people have become more financially savvy, whether that is managing your own investments or managing your own finances in a much more sophisticated way than people did maybe 50 years ago, that kind of ask for financial products that allow you to kind of risk manage yourself. I think it's only going to increase.
Yeah.
So I think that's a very positive. I think it's also a very, I think that ability to take individual action to manage your own finances is a very positive, message about individualism as well. You can make provision for your own future. And I think that's engaging regulators in the right way about that. It's going to be a challenge, that they want to make sure that you're not taking advantage of people. And but at the same time, I think there's a huge, very positive message. And that's one that, in fact, underlines a lot of the value proposition, I think, for cryptos.
Yeah.
So last trade idea, I'll try to go through this one in 2 minutes if we've got any time.
Right. Yeah, let's do that.
This was actually one that came out a couple of weeks ago. There was a hack on an exchange called KuCoin. And this is one that is quite interesting in terms of just tracking as a quant, because one of the things is going to know is it bad news events are going to hurt, to some extent, the price of all cryptocurrencies.
Mm-hmm.
And understanding how much it impacts and the prices is important. So one of the things I was actually looking at after this hack was the coins that were hacked and the price impact. And it happened to correspond to a series of talks that were happening with between Cardano and Ben Gertzel, who was Singularity.net. This coin is AGI. Was part of that hack, and so this was one where it was a very interesting situation where it came through on a Friday, that hack, but the coins took longer to figure out what the coins were, and this was a case where we started to see a huge spike in volatility. I hope you can see this spike down here.
Yep.
In the volatility. Where the volatility was raising much above average, and my thesis was this was hackers that were selling off the coin, and they happened to be doing it at a time that I thought that as they were talking about this coin in front of the Cardano community, this is kind of a new community for many of the AGI holders. So I thought this is going to create some demand in that community as well. So we should appreciate some price appreciation at the same time that we're having this incredible pressure of people coming into the market and selling off. And so that was kind of this trade thesis of watching these people come in. So I put a couple buys and sells in just on the back of this, and let's say that if you were looking at this, you might put on let's say a Bitcoin trade, and which might be a large trade under many circumstances. But again, we're seeing these incredible volumes of millions of dollars coming through, where that was coming through in hours instead of in days, where it would normally take, so that you could put on some bids. And I kind of took a view on this being a 4 standard deviation move, and way outside of what you'd expect from a normally distributed. This is tail risk, and so I said this sounds like a good opportunity to get in, and into a coin that maybe is going to move up, but at a buying opportunity. There's this pressure and going on with this, the selling off here. And so, you can put in a maker order, and the market eventually got there. I mean, I kind of timed it again, looking at VAR numbers, looking at statistically what kind of outcomes were likely, and pitching it towards the more unlikely outcomes. This is a big event. This is not a random walk event. This is an event that I think is going to push beyond it. But we've got some view on some other events and other coins that about 10% was where they move in a reasonable, and this is over the course of a couple hours.
And this is the example of an event-driven trade. Is that right?
That's right. So this isn't necessarily an algorithmic one. This was one where, you're just listening to the news and thinking there's something going on here. How do we benefit? This is not one that I would do algorithmically, because it was very much looking at chatter, but also this really cool product, that was kind of getting shown in front of what I would consider a new audience, and that was one where I thought that should at least spark some interest. And and so there was actually this recovery afterwards. I did take a view that the miners happened to be Asian, and they were going to do most of their selling in Asian hours, and that may or may not have been true, but it did in this case happen to largely correspond to early hours in Asia. They got up at 7 a.m. that morning and started, and I don't know exactly who the hackers were, but and then it came back in the subsequent period of time after that initial sell-off. And we did see some subsequent sell-offs after that, but that recovery, again, that's more of a random walk. As people are coming in, we've got a sort of a view on what a news impact kind of outcomes. And I'm not a believer in calling tops or bottoms. I think that's a hard one. You're going to say, where is it profitable to take some money? Don't get greedy. Just take your money and there's a certain fee that you're going to make, and you're going to have a certain profit target. So, and you can kind of pitch it on that. And this was a case where I thought, if it doesn't get executed, I'm still actually fairly happy with this. This is kind of a cool product. This is a coin that looks interesting. As a science fiction fan, I'm intrigued by the idea of general intelligence, artificial general intelligence anyway. So this was one where I was happy to see what was happening and get in and play with it. And it also gives you a feel for, I kind of like as things get talked about, it's quite useful to have a little bit of insight. There's no substitute for playing with things.
Yeah. I mean, I see in the chart that the price never recovered fully. It looks like, which means that if you owned it at that point, then you'll probably own it right now, and maybe you will recover, but maybe in 2-3 weeks where you can actually sell it.
Yeah, and I think that's one where you may be in fact be quite happy to hold it at those levels, thinking of some price appreciation. That would be my take. I can tell you that I part of another investigation was just looking at what Ethereum gas fees were. So putting some of that into the staking program they had was kind of an interesting way to test what Ethereum gas fees were over a couple different points. Wow. I'm a big believer in empiricism rather than calculation when it can be done. Just as a total aside. So that's kind of another interesting trade idea where you're kind of just looking at events and kind of playing supply and demand. You're buying when people are selling, and selling into buying activity. And I quite like that because there's a clear value proposition, which is just you're kind of facilitating the buying and selling and reducing the price of the asset. There should be a long-term business in that, and that's a long-term value add to the system. Particularly things like the market making are a huge problem for new coins. And that's one where I think that there is a virtue to an extent on that, particularly when you're only playing with maker orders. If you're only doing maker orders, you're not bidding up the price, you're not tanking the price, you're not taking advantage of any kind of games that people might be playing. You're sitting there trying to stabilize the price to an extent, and taking
it's a service. It's a service.
It's a service. It's a long-term service, and I think that when you can trade like that, that's a long-term opportunity. It's not, some of these when you think, oh, you're profiting off a hack, that's a once a year type of, just put a little bit of money down and see what happens.
Well, I mean, you could justify it, by saying the hack has no bearing on the coin's fundamentals. So if you're selling that, it doesn't really mean that, why shouldn't I buy it? It doesn't make sense in the sense that, yeah, it's a temporary supply and demand mismatch that led to that price decrease, but you would be not a very smart trader if you don't take advantage of that, and that stabilizes the prices. Imagine if you weren't there to pick up that deviation, basically.
Exactly, and that was one where up to that point I wouldn't have been, even though we're not regulated in the same way as a thing. I know that within the company there were people talking to them. And so that's a trade I couldn't have actually made until Charles had that conversation, which was a nice fortuitous time to start playing with that one.
Now, Colin, I would like to basically cover the last segment, the psychological traps of trading. What kind of psychological traps have you identified in your career, and how do people avoid them?
Well, I think one of them is watching the market too much. I think that you have to set reasonable limits where you're going to get in and get out of a trade, and try to set those up ahead of time so they get executed whether or not you're watching it. And then you can kind of go home at night. I think that having even a discipline like this is my upside, this is my downside, and if that downside is ever unlimited, you just don't do the trade. You kind of want to think, okay, this is, and I think having some clarity around what your thesis is and say, do I still believe this or not, is a strong one. When you're actually doing trading, I think that you can't get too attached to the assets that you're trading. You have to be willing to go both sides of it. And even if you like something, it may be overpriced, and you may not have a lot of respect for a coin, but think it's still undervalued. And those are what do you say?
Dogecoin. That's what I said.
Well, I think you want to have a certain degree of comfort that it's a real project. I think that there are meme coins, that you might call them, that have no value, whereas you can think this has got value. I may not like these people personally, but their coin has some value, and so you don't have to take a thing. And that's one, I think one of the biggest traps is only investing in things you really like, because a lot of other people might really like them and they may be bid up a bit more from where they should be. I think that cryptos are kind of an interesting asset class, because I think in general, as an asset class, they are quite undervalued relative to where they'll be long term. And that's because there are a lot of dodgy players. There are a lot of questions about regulations and legal requirements. There's a lot of questions on what are going to be the big applications and the winners out of this, and who's going to deliver that value. So there's a lot of expectation of this long-term value, and that makes it a little bit easier to speculate in crypto, because even if you're stuck on some coins for a while, as long as they're decent coins, their development teams. One thing I look at is things like GitHub commits and development timelines and things like that. If it's a real project that people are committed to, they've got a real community behind them, holding it for a little bit longer and thinking these are things that we structurally have some reasons to believe, because of the number of dodgy players. You can make some choices about coins that have a real value proposition, and I think that's pretty positive too.
Yeah, perfect. Yeah, I mean that covers a lot of things that a lot of points that traders might consider when entering this space or trying to set up their trades in this space. So it's a great thing that you were here to talk about all these
I do have one
aspects.
last piece of advice.
Yeah.
Write down your trade idea before you trade. And then when you take profit at the end, see if your trade idea made sense. Because I've found that the discipline of doing that is really helpful, because after the fact, you think, oh, of course that made sense. And you have this ability to explain to yourself why you were brilliant ahead of time. And sometimes if you look at what you wrote down ahead of time and you look at what actually happened, it's easy to fool yourself that you're better than you think you are. And I think that's a trap it's very human nature. And it's quite humbling to sometimes look back what you've done that has been successful, and you think, I got lucky. What I thought was going to happen didn't, and I was in the right place at the right time, and I caught something, and that's, I think, a discipline that most people need to focus on. Is there's a bit of humility. It's hard, even when you're making money, particularly when you're making money, that you attribute it to the right things.
Yes, it's called a hindsight bias. So when things happen, then you say, "Of course, yeah, that's what I did."
Of course, I knew that.
Yeah, thank you so much for coming, Colin. It was a great session. We covered trading basics, we covered executions of different strategies, and then we went over the psychological traps of traders in this space. So that was our guest again, Colin Edwards, the quantitative strategist at IOHK, who was giving us all these valuable insights today. Thank you for
I
coming.
hope it was fun. I certainly enjoy trading,
Yeah.
so it's a really fun hobby, I think.
All right. Thank you very much again for coming, and I hope to see you again soon in this podcast. This marks the end of our episode today. If you like the content, don't forget to subscribe. Otherwise, I will see you next time.